Coming up on 7:17, live shot from Century Plaza Hotel and Spa. The announcement just came down from the Bank of Canada, moving up the key interest rate 25 basis points. Katy Mackenzie, mortgage professional, joining us right now. Let's make sense of this, because when we hear interest rates go up, panic can ensue. What does this mean for the average consumer, their debt, their mortgages?
Yeah, so I'm sure everyone's tuned in to their televisions, news stations this morning, because the key interest rate has increased by 25 basis points. So if you are in a variable rate mortgage or line of credit, your interest rate this morning has gone up. So let's make that, tune that into what that means actually for you for cash flow wise. So per 100,000 of mortgage balance that you carry, if you're in a variable rate, your monthly payment has gone up by about $13. So if your mortgage is $500,000, your monthly payments have gone up by $65. Doesn't seem like a lot, but as key interest rates are introduced through the following balance of the year and into 2019, that can continue to increase. If you are in a line of credit, this key interest rate hike actually increases your monthly payment by $20 a month per 100,000 of balance that you carry on the line of credit. So your monthly cash flow is being eaten into a lot faster than even on a variable.
This is a real opportunity if there is a lot of debt you're managing in your life to look at. What about things like car loans? That's another big one on the monthly basis. How does a key interest rate impact that?
Well, key interest rate doesn't impact directly car loans or Visa card payments. But what it's starting to do now is eat into your monthly cash flow. And you may want to be considering early renewing or refinancing these lines of credit, because now you're going to have to decide what's more important to pay, your car loan, your Visa bill, or your mortgage payment, right? People are concerned about coming into a situation where, you know, they may have to claim bankruptcy, right? Okay,
so two questions here. If someone is on a variable rate right now, is it time, given this is the fifth bump since the summer of 2017 with the basis points going up, is it time to move variable to fixed?
It's a great question, and it is client-to-client scenario specific. Personally, I would say it's a great time to absolutely look at it, because if this morning your payment just went up by $65 a month, if you're in a $500,000 mortgage, can you increase or stomach a further increase in the coming year? Let's say the key interest rate increases another 25 basis points in December or January. Are you going to be able to stomach those changes? You know, consider why you went into a variable rate in the first place. Was it to eat into those great low rates? Well, they're eking up, right? We've been in historical lows. Last summer was the first increase to prime lending rate in over 7 years. So now is a great time to look into it. And if you can't sleep at night because your payments are going up, yes, absolutely lock in and enjoy a fixed rate for a new 5 fixed-year term.
What are you seeing right now in the market? Competitive variable rates as of this week and competitive fixed rates that are out there?
I looked at a scenario last night with a client, and with the specific lender that we were looking at, there was a 0.94 difference in interest rate between a variable and the fixed rate term. So there is quite a big spread between the two. Competitive rate, lender to lender, depends on your specific scenario. So the lender you're going with, amortization that you're looking at, your credit rating, loan to value, so if it's high ratio or low ratio, all of those factors factor in.
Final question for you. If we're in a fixed rate right now, there's only 2 years left on the term, and we're looking at these rates go up, is there an option right now to renew and get a 5-year and lock in at a lower rate given what's happening?
Absolutely. People only assume that you can early renew in a variable, but you can also early renew in a fixed rate term. It just depends on the term that you're in and the contract that you're in. So speak to your lender. Ask them what options that you have today to lock in at today's rates. Maybe to refinance in that car loan or that credit card debt that's mounting and compounding monthly for you. So absolutely, time to have that conversation if you are renewing, either in a variable or a fixed in the next year or two.
Some tough money conversations coming up. Katy, thanks very much. You see the website, MackenzieMortgage.com, for more resources. Appreciate you coming by.
Pleasure.
All right, we'll talk more about this and